Hello, everybody. Welcome to the Real Estate Investment Education Club. This is October the 16th, 2020. My name is Daniel Homland, and we're glad that you're all here. We are set to hear from another excellent speaker in the area of real estate. His name is Tom Schneider. Before we get started, there are no announcements. Well, actually, there's two announcements currently. The first one is that we're going to be starting up our discussion groups again on Tuesday, the 20th. I believe it's the 20th. Yes, next Tuesday. And those are happening at 11:30 Pacific time to 12 p.m. It's just a half hour. It's just a time for us to get together and chat, ask each other questions, tell each other stories. It's just a time for investors to get together and talk. So there's no set agenda. It's just whoever shows up and wants to talk. And the second thing is that we have a date scheduled for our panel discussion. Quite a number of people have been talking about having a panel discussion, and that is going to be on the third week of January. Quite a ways out. We are actually very booked, except for the day after Thanksgiving, the week before Christmas and Christmas Day, and the 1st. But other than that, so actually those 4 days that I just mentioned, again, we will not have a club. So the day after Thanksgiving, the week before Christmas, and the 1st, there'll be no club. But starting in January, we've got 2 speakers, and then the third day will be our big kickoff for the year with a panel discussion featuring Intel employees who are also real estate investors. So if you're interested in that, email me. I would love to, bring you before the REI steering committee, which is the 4 of us currently, and potentially get you on that panel. And actually, I do have one other announcement. A couple of weeks ago, I sent out a survey, and one of the questions was, would you like to be part of the Intel steering committee? And I had 5 people that said yes. And unfortunately, true to Intel fashion, it was an anonymous survey. So I don't have your names. If you are interested, please contact me, and we'll talk about it. And we definitely, I'd like to get this club running so that if any person on the leadership committee bowed out, myself included, this particular meeting would still continue. So my goal is to get it in a autonomously running fashion. And if you'd like to be part of that, just send me an email. All right, we're going to kick it over to Tom Schneider from Roofstock.
Awesome.
Tom.
Thanks. Hey, Daniel. Thanks, guys. Thanks for having me here. I'm just going to confirm real quick that everyone can still see my screen now that it is in present mode.
Yes.
Okay, perfect. Awesome, guys. So today we're going to be talking about proven steps and strategies for succeeding in real estate investing. Before we get going, a little bit about myself. So I am the Director of Investor Education here at Roofstock. I previously led the operations team, and before that, I was in the product management, a product manager. And before that, I was working at one of the very first single-family rental publicly traded REITs, leading their product. Super fun role, building tools for doing acquisitions, property management, leasing, all of that fun stuff. I'm also an active investor in the Southeast and Midwest and Northeast, and I'm a California broker. And so for today's session, it's going to be roughly, I'd say, between 20 minutes and 35 minutes. Meant to be pretty conversational. As you guys have questions, feel free to type them in. Daniel's going to moderate, and he may pepper a few as we're going through this, but we're definitely going to save some time at the end. So excellent. Let's jump into it. So for the agenda, we're going to be talking about why to invest in SFR, and that's an acronym for single-family rentals. We'll also talk about why not to invest in single-family rentals, talk about some of the major strategies and decision points, talk about the major risks, as well as some pro tips. Excellent. So let's go into it. So why invest in single-family rentals? So first off is the return profile that you get with single-family. There's 2 pieces of it. You're getting that immediate cash flow on the rent that you're collecting, and they're also capturing that appreciation. And I'm going to go through an example of what that looks like. And when you add them all together, it's really remarkable total return. The other aspect is loan paydown. So this is the getting debt is very cheap right now. And what's crazy about this is I can go get a mortgage and have somebody pay it off, and then at the end of the asset, The third is the tax-related advantages. And within real estate, a good way to remember the three of them is the 3Ds. So deductions. So any cost that you're spending on this investment, you can deduct it. Depreciation over time, you can depreciate your asset, and then deferral. So if I was to sell my rental property and use the proceeds from that to buy another rental property, I can do that and pay no taxes. And that's through 1031 exchange. Pretty remarkable. My wife's a tax attorney, and she's still like confused about how kind of a sweetheart deal real estate is with taxes. And a corollary to that would be like if I had stocks and I sold my stocks and used the proceeds to buy another stocks and didn't pay any taxes on that. You have to with stocks, but with real estate, no, you can keep leveling up if you want or break it out. So awesome tax advantages. Lastly is just the aspect of getting this to be completely passive. And I'm going to say eventually, just because getting up and running, there's a little bit of overhead. But eventually, once you have things in place, properties purchased, good system setups, it is truly mailbox money. All right. So touching on the specific return example. So this is the way that I like to think about cash flow returns. So in this very simple example here, we have a property acquisition for $100,000. We're buying it with 20%. So we're putting $20,000 in, immediate renovations to be done, saying it's in pretty good shape, just $2,500. So here's a total upfront cost of $22,500. And now when we look at what we call the net operating income, we have our monthly costs that we're paying with mortgage reserves, if we're paying any mortgages and property management fees. Within this particular example, there is a net operating income of $234. If we annualize that, the net operating income, which is returns after paying everything, it's a little over $2,800. So a way to look at returns on a cash flow basis, and they call this cash on cash, is taking that annualized net operating income and dividing it by the money it took you to buy the property. So in this particular example is a 12.5%, what they would say is cash on cash. But as I mentioned, this is only accounting for one type of return within single family rentals. The other is appreciation. So using this same example of that $100,000 house that we bought and we used 80% loan on it. In this example, we're going to assume a 3% appreciation, which is pretty common. So in this particular example, the property appreciated 3%, $3,000, but the money that we put into buying it, we didn't pay $100,000 because we used debt. We put in $22,500. So in this example, we're looking at a return of dividing that appreciation, $3,000 divided by the initial money we put in. That's a 13.3% return. And as I said, what's so fun about this is both of them are working at the same time. So when we look at a total return aspect, we can see a 25.8% return. So we put that $22,000 in, and we have our cash flow that we're earning as well as our appreciation. I'm pretty conservative. I wouldn't count on that appreciation just because, generally speaking, real estate appreciates over time, but I love the cash on cash flow aspect, but if I want to feel good about myself, I'll also think about the appreciation. So looking at this particular example, it shows a 25.8% return on your money. All right, so this next point is why to avoid single family rentals. So one of them is capital requirements. It takes a good chunk of change to get in and start to buy these properties versus stocks, where you can get in as cheap as $1 or a penny or whatnot. Another reason to avoid single family rentals is there's relatively low liquidity, as in it takes me a good amount of time to move, to acquire and to sell. This is something that Roofstock is trying to solve, but it takes time to solve those types of problems. So versus other asset classes, it's relatively low liquidity. Another aspect is it's not a get-rich scheme. So I love to use baseball analogies, and I think with real estate investing, it's a great way to hit singles and doubles on a really regular, pretty safe way. But this isn't not speculation. Very rarely are you going to get where you can buy one property and get like a 10x or some kind of those outweighted returns. The other is ongoing overhead. So there is some ongoing work that you do as an investor. Your taxes are a little bit more complicated, but that extra complication is worth it because you can really squeeze a lot of juice out of that. But relatively higher ongoing overhead versus stocks where it's pretty plug and play. But with that said, still a big fan of it, but I think it's important to know what kind of hurdles that you're running into as an investor. All right, so why some investors succeed over others? I think one of them is having a very specific kind of plan in mind versus just kind of the shotgun approach. So there's this tool that we have that, working with some of the members we have as part of our Roofstock Academy, it's a lot of people have a similar goal of, okay, I want $200,000 of passive income. It's basically looking at done, right? What does it look like in, let's say I have a time horizon of, I want to get there in 10 years, and then working backwards, how many new properties do we need to acquire? How should I be thinking about my debt costs that I'm doing? So having a very specific plan, I think, is really important. The other one is being intentional with risk. I'd say one of the biggest mistakes that most investors make, specifically on Roofstock, is they'll look at some properties that have really high returns, and they aren't thinking about the risk of that. I mean, real estate can be kind of similar to bonds, where like if I'm buying a bond in Venezuela versus a bond in like France, the perceived risk is going to be higher in a country that is riskier. So you should expect higher returns. Within real estate, there are different ways that we can quantify risk. Roofstock has this score called the neighborhood score. It's at a 5. Other ways that you can look at it is looking at the school scores is really a good way to see what is the kind of perceived risk or about an area. But at the end of the day, what I mean by being intentional with risk is this concept of risk-adjusted returns, where if you're buying a property in a really nice area, you should be okay with taking lower returns versus buying a property in an area that is quote unquote like riskier. You should expect higher returns, if that makes sense. So risk-adjusted returns. The other key to success is bias for action. I think it could be really easy within real estate just because there is a lot more moving pieces to get paralysis analysis and not necessarily make any moves. So having a bias for action, like I said, like have a plan, but then move on that plan and feel confident in that plan and that you have, and be okay with adjusting as you need to. The other piece is sharpening the saw. You guys all have a proclivity for that, and being in today's presentation today. So keeping educated, investing can be a moving target. And there's a lot of benefit also to having either a mentor or a coach where you can get a sanity check, you can get a kind of accountability and moving forward and all of that good stuff. So excellent. Continuing on, let's go ahead and take a look through some of the major different strategies and decisions points that you make as a real estate investor. So what I have here listed out is different types of strategies and a matrix looking at thoughts around overhead and skills required, liquidity, immediate return, and then general volatility. So this first type that I have listed is really my bread and butter that I personally do with me and my family, is just long-term buy and hold, where we want to buy it and just build a big cash machine that we can live off at whatever point we need to or want to. So this is, I would say, relatively lower overhead and skills, just because with a longer time horizon, it's going to be a little bit more forgiving in using a sniper and being really specific on what property. I mean, obviously you want to do your homework and do the acquisition process right, but I would say in a long-term buy and hold, it's a little bit more forgiving. As I mentioned, with hold time, there's going to be less liquidity, just because you're parking that money in there and just kind of letting that property, letting it run. So a little bit less liquidity. I would say medium to lower 12-month return potential. If you're trying to, with real estate, to turn money very quickly, that's more of kind of a flipping strategy, but it just requires a significantly more amount of time. Other just, intuitively short-term buy and hold is hello?
Oh yeah, I watched this one.
So continuing down these different types of strategy, fix and flip, as I mentioned, is a lot more overhead and skills. Like, this is having a really keen construction background as well as valuation background, short hold time. One thing that just seems risky for me that I don't like about this strategy with my own, that I would want to do with my own money, is, if there is some turn in prices, like, you can get your hand caught in the cookie jar where you've bought all these properties and the prices go down a lot. I just feel in a longer hold strategy, you're going to ride out those waves of that value that happen. The other fun strategies that here at the bottom, so one of them is a house hack. So what this is buying a duplex, living in one of them, and then renting out the other one. This is a great way that you could take advantage of extremely low money down, where you can get a loan for like 3%, doing what they say is a house hack. Again, this is buying a duplex, a triplex, or a fourplex, and then renting out some of the other units. There's a little bit of overhead in that, if you're living in the unit, you're going to have somebody there with you, and the toilet breaks or whatnot. It's, you get the knock on the doors. The last one here, and some of you guys may have heard this acronym before, BRRRR. It's a term that was coined. I'm going to give Bigger Pockets credit. We like those guys. It's where you buy a property, you repair it, you rent it out, and then you refinancing it. So the way that works with regards to cash flow is, let's say you buy a property for $100,000. Then that property, you fix it up, you put $20,000 into it, then you rent it, and then you refinancing, assuming that you were able to get some sweat equity. The debt that you get back when you refinancing it could make you whole, where you basically paid nothing for the property. An example, I have kind of a hybrid BRRRR strategy where I will use financing when I initially buy it. So let's say I buy a house for $100,000, I put $20,000 in, it appreciates to $130,000. I'll refinance it at $130,000, and I'm basically getting that initial $20,000 back. So I have the property, I have a loan on it, but I'm basically paid nothing for it with regards to down payment, because I refinanced it after it had appreciated to kick me back that initial money I'd put in. So a really cool strategy with regards to scaling quickly. You're going to have a little more debt with that strategy just because you're refinancing it, but you can have your capital work a little bit further by buying new properties. All right, making sense, everybody, so far? All right, let's talk about some different return profile strategies. So this has a lot to do with when you're thinking about risk. So there's some terms that Roofstock has coined as that properties can be more for supplemental income. These are properties that are cash flowing higher. They may have less upside on the appreciation because perhaps they're in an area where the school scores are not as good. There tends to be a little bit more volatility in these types of areas. So this is a supplemental income, thinking high cash flow, a little bit higher risk. Then there's a concept of a balanced investment. So this is a property where you're still getting some cash flow, not as much as the supplemental income, but just kind of down the middle. This is balanced investing. And then there's long-term growth, where cash flow perhaps even neutral, but you're just kind of banking on a very nice area that's going to have outsized appreciation and then relatively low volatility. So I think in my experience, a lot of investors start as more kind of supplemental income and then transition to either balanced or long-term growth. But there's people who've had a lot of success with different types of strategies. So it's not like there's one size fits all.
Hey, Tom, we have a question about the BRRRR strategy.
Yeah.
This is from Glenn. He says, in BRRRR, do you evaluate the refi costs as well as the higher monthly interest in your return calculations? Or is it ignored? Are you simply trying to get capital out and initiate the buy and manage the NOI separately?
You should think about it holistically. So there definitely is some friction with the refinance costs, but using that simple example of I bought a property for $100,000, I refinanced it at a new value of $140,000. My ongoing debt servicing is definitely going to be higher just because the loan is bigger, and I paid some extra money to get it refinanced. But with that capital I'm moving out with the refinance, that's going to be used to acquire another property. So when evaluating the returns in that type of a situation, you should really include both properties into what, in modeling out what your returns are versus just the one. Because on that one that you're doing the BRRRR strategy, it's definitely going to not cash flow as well just because you've increased the debt on it. But if you net this additional property that you acquired, that should be part of the calculus, is thinking about that other. Does that make sense, Daniel?
I think so. Glenn says yes.
Cool. All right. Let's talk a little bit about different property types. And this is a simple matrix we have here, looking at kind of basically the kind of a gamut of different types of real estate properties. And today's more focused on single family and small multifamily. But the single family residence, this is all rooms reside under a single roof, and yeah, that's single family. A condo is a property that is within, usually it's like connected walls, and then there's this concept of a homeowners association. Condos are, I'd say, less, for me as an investor, a little bit less desirable, just for a couple of reasons. One, there are ongoing HOA fees that you pay that can be kind of expensive. And again, there's always a case-by-case situation. But an HOA fee is something they typically don't appreciate as quickly as SFR. Another thing that I like about single family versus condos is a lot of the draw for people in buying single family homes is to have that backyard and kind of area by yourself. And with a condo, some of them do have like backyards, but generally speaking, not in the same way that a single family. So single family typically demands a little bit of a higher rent and has longer leases, so there's less vacancy. So condos, the other thing about condos is within the rules of the condo, they may have rules against renting, not being owner occupied. So something that you need to be really careful of if you do buy a condo as a rental, knowing what they call them CCs and Rs, what the rule for renting. The other is small multifamily. So this is multiple units under one roof, and this is a fine strategy to have. I think multifamily investing is great, and you can do the house hacking if you're just getting into it. Typically, your cash flow is going to be a little bit higher just because you're paying the one set of property taxes, on multiple units, and that acquisition cost, you get multiple units for it. Some people may argue that for the same reason I said, the benefits of single family rental, where you would typically have longer leases and demand a premium rent, you may not get that with multifamily. And then there's much larger multifamily stuff that I'm just less versed in. One of the differences is when you get to larger multifamily is you can't take advantage of the extremely cheap mortgage rates that you can getting single families, condos, or small multifamily. So with Fannie Mae, you can get up to 10 loans in your name to buy these type of properties, getting the same type of rates that are just incredibly cheap that you would get if you were to buy a house that you were going to live in. So the cost of debt is extremely cheap within these three, versus larger, where it ships to commercial loans, can be a little bit more expensive. Cool. So this is kind of just hammering on what I just touched on real quick. So with single family, typically a little bit more longer leases and higher tenant stability, better appreciation. One thing that I like about single family is there's a lot more inventory. If you think about, anywhere, there's a lot of single family homes versus if you're buying multifamily or duplexes, there's just less inventory, so it can be a little bit more competitive. Always single family homes, a lot of them out there. Let's see, and yeah, I think that kind of covers it. Looking at tenant stability, typically a little bit less with condos and less with multifamily. And then cash flow perhaps a little bit higher when you start getting multifamilies, just because of those economies of scales you get with having multiple units under one roof. All right, ownership strategy. So I am not an attorney, so I'm not going to go too much on this, but the way that a lot of investors get started is just holding the property in your own name versus putting it into an LLC. I think it's a fallacy that you have to get an LLC to start being a real estate investor. The biggest thing you're getting with setting up that separate entity to hold it is some liability protection, but you can buy insurance that effectively offers you the same type of personal protection that you would get from an LLC. Another downside of doing an LLC kind of right off the bat is you can't take advantage of those same cheap rates, because a lender, if you're holding that loan in your name, you're going to be able to get much better rates versus if you have it in an LLC. The rates are typically going to be higher. So if you have one takeaway from today, it's don't feel if you're going to buy real estate, you have to do it in an LLC. It can be a good strategy to kind of get going off the bat initially in your own name and then potentially transition into an LLC later. But there's a lot of good reason to have it in your own name. The other ownership strategy, which I'd say is the kind of ownership strategy, would be buying into a REIT. So a REIT is a stock that is perhaps consists of a portfolio of homes. So I worked at a company, it's now called Invitation Homes. It's a publicly traded REIT in buying us that owns single family rentals. If I wanted to participate in them, I could buy some of their stock. The problem is with that kind of strategy is there's a lot of additional overhead, like in that management company of owning that. Most of those REITs also have the same lending profile and the same geographic footprint, where if I want to be a little bit more of a sharpshooter, I can buy these properties individually versus buying into a REIT. Another thing that I'm not, that I enjoy direct ownership versus a REIT is with some of these REITs, it's, interwoven within this global economy where the value of the stock, even though that home is performing great, collecting rent, yada, 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 that value of that stock may change because of outside control, had nothing to do with the performance of that house. So just my 10 cents on the REIT. I saw a couple of questions. Daniel, feel free to keep chiming any of those questions that come in if they make sense. This is just looking at sole ownership versus owning it in an LLC. If you're buying... Go ahead.
I was going to say there is a question here actually on the refinancing.
Yeah.
And let's see. There is, to refi a property that you currently own, how do you find the lowest, most reputable lender?
Yeah, that's a great question. So a huge part of success is partner management and partner sourcing and vetting, and lenders are a really important one, and so is your property manager, especially as a remote investor. But finding the best lenders, there's a couple of them out there that I can just talk about right now. I've worked with a company called Arvest that I've done to refi. AM Loan, AIMLOAN is worth talking to. So I think it's worth talking to, at least like 3 of them. And when you're talking to them, there's a couple of things you want to get. So one, like what is their rate, right? Another is what is their origination cost? With these banks, with these lenders, there's 2 ways that they're making money. They are either making money on the origination cost or they're making money on the interest rate being higher, and then they sell it on the secondary market, and they can make like the difference on that. So typically what you'll find is lenders that have no origination costs will have slightly higher rates, and lenders with high origination costs will have slightly lower rates. Not always the case. Those were a couple lenders that I recommended. I recommend if you're working with an agent, like, oh, here's my Maslow's hierarchy of vendors. So the top of the list is personal references, so other investors you know. The second level would be a professional relationship. So you're working with an agent, see who if you're working with a PM or insurance, like see what there are. The third level would be forums. I mentioned BiggerPockets before. They're always talking about different vendors and all that kind of good stuff. And then lastly would be just the old search, like Google search in an area. But I would recommend kind of that level of looking.
All right.
Yeah.
It looks like we're getting several more questions, and feel free to put them into the chat room. I do ask that you limit yourself to 2 questions per person, just so we don't have, a few people that contribute a lot. But the next one here is, could you explain the 10 loans with extremely low rates in more detail? Do the loans all need to be defined as primary residences?
Nope, you can define it as an investment property. And this has to do with Fannie Mae, which offers insurance to these original lenders. Just as an individual, you get a count of 10. It's these rules are kind of funny, and I don't know, like, I think it's Fannie who makes them. So what I do with my wife is I have these properties that I own just in my name, so we can kind of double and expand that. So in buying in her name, it doesn't count towards my 10. What would be a mistake if we put them both into both of our names, because then we would be wasting those 10, right? It's better to hold them off as individual. But to kind of just backtrack to the question, what's the deal with the 10? These are the number of loans that you can make in your name that Fannie will provide the backstop on for the loan. So for whatever reason, 10 is the number. Once you get over that 10, that's when you start getting private lenders. And the rates aren't quite as good, but usually at that point you're at a little bit more scale and have more properties. So those are good problems to have once you get beyond. But just getting off the bat, like you basically have 10 in your back pocket where you can get these rates that are like 4%, 3.5%. Right now, they just continue to drop.
All right. Our next question is from Muin. I've heard that it's impossible to get insurance to cover tenant vandalism. Can you get insurance to cover vandalism from outsiders, but none that cover vandalism that is performed by a tenant?
I mean, that's a good question. Usually the deductible with an insurance policy isn't too much lower than $2,500. So, I mean, I don't know what kind of vandalism they're doing, but if a concern, there's ways that I think you can mitigate. Just going back a step, I think there's ways that you can mitigate that risk on tenant vandalism. So in working with your property management around the way that you're vetting tenants, is a way to answer the specific question on, is there extra insurance you can get for tenant vandalism? I think if the cost goes beyond a certain dollar amount, you can dip into that, but I'm not totally sure. And to be honest, I haven't really heard of that being much issue where tenants are vandalizing so much that a specific insurance policy is required. So, I haven't dealt with that kind of an issue, and I haven't heard of a lot of other people that kind of deal with that. I think perhaps based on the area, there could be more of that in specific areas. That's another ways that you can mitigate risk around that.
Yeah. This question is from Young. Mm-hmm. How does Roofstock vet property managers in the listings? How can a property manager get into Roofstock's listings?
Yeah. So what Roofstock does is when we open up a new market, we'll research what are the different property managers in the area, and based on the top, 5 or 7, we'll get on the phone call and start this vetting process. And there's a couple different categories that we'll vet a vendor on. So what is their operational metrics? So what's their occupancy rate? What's their turn time? what is their repairs and maintenance and like standard operating procedures. Then we'll go into the office. We'll look at some of their different legal documents they use, as in a property management agreement, their lease agreement, all of that kind of stuff. Make sure that it's in reasonably good shape. And then based on that, we'll identify 2 or 3 within each market that we'll recommend. What Roofstock does when they sell the property is people buying will offer like, hey, you can use this property manager, but you don't have to. So I like to think of Roofstock as sort of the river guide, where giving you the resources if you need it, but you don't have to. If you want to pick your own property manager, if you want to self-manage, great, that's all good. I do recommend everybody being thorough on, even if Roofstock does an initial job of identifying a couple property managers, still going through the exercise of interviewing that property manager and getting some references as well. So that's what Roofstock does to find a local property.
And there was a slight clarification on the insurance question, and Muin was specifically talking about vandalism due to disgruntled tenants when being evicted. I don't know if that changes your answer or not, but I wanted to make sure to clarify that.
To be honest, that it's so I worked at a company that owned 20,000 of these homes, and it was just a pretty rare situation where that happened. I mean, I've anecdotally like heard of horror stories around that, but that would be a good question that I would have for an individual insurance carrier. But that's not something that's on the top of my mind in seeking out. I'm sure like people could write, a policy on anything, but I think the likeliness of that kind of stuff is pretty low. So not a great answer, but just from my experiences, it's not super common to have an eviction and then just the tenant basically light the house on fire. Is not a kind of a common thing that I've seen.
All right, and our next question is from Ashok. I'm a bit confused on single-family residences. At one point, you mentioned, is it advantageous? And another slide shows why not to buy single-family properties. Can you please clarify?
Yeah, I love it. Great question. So I think with any type of investment, there's going to be pros and cons, and I think it's important to know those hurdles going into it. So with investing, there's always risk and return, and I think it's, like I said, important to know the downsides of it. If I could buy a money printing machine, I would buy that, But it's for the reasons, the benefits I think outweigh the negatives, but it's important to know what those are.
All right, this is a good question. Can I transfer the ownership of a rental property to a child, 18 years and younger, and use that income to pay for college tuition?
Yeah, love that. That's my plan is, with all the kids, get at some point in time, transfer the ownership over either through like a quick claim deed, or there's like a couple of different maneuvers you can do that. But a huge part of real estate planning and strategy can turn into estate planning and how you want to divide that. Another thing that people like about single family versus these larger multifamily is, in doing estate planning, it's a lot easier. So instead of having some, $10 million building that I divide amongst a bunch of kids, like, hey, I can just have, okay, these 4 properties are for you, these are 4 for you. It's way more easier to divide and cut it up. But you can definitely, estate planning is I think a big part of it, especially as your portfolio gets bigger and bigger.
Here's another good follow-up question. Does having one spouse's name on a deed but not on the mortgage affect the limit of the 10 for individuals?
I'm not sure if the lender would allow that. Like, I think it might be the owner. I know I would assume that the lender would want the name on the deed to match. But with that said, there isn't like necessarily like a mortgage police that's going to, perhaps there is at some point down the line, but I would be surprised if a lender would allow you to get a loan when that your name isn't on the deed, if that makes sense.
Mm-hmm. Yeah, and it does vary from place to place. I know from my own personal residence, my wife and I are both on the title of the property, but my name's on the mortgage. And
Oh.
it turned out that I forget what the reason was that, but it was something that was recommended.
Yeah. Yeah. No, I mean, I think as long as the borrower's name is on there, but maybe it's we have a similar thing where we got a home equity line of credit on our house. Both of our names is on our owner occupied mortgage. But since I had a bunch of these rental properties on mine, the home equity line of credit, the lender wouldn't let me get on the HELOC for whatever reason, even though these are like have real, performing properties where it's a really safe amount of debt. So the HELOC is just on her name. So as long as the person whose name is at least one of the person's name on the title, I think they can get the loan on it.
All right. And JA is comment. Oh, I'm sorry. This is a private comment. Never mind. Here's another question. One concern with buying non-local SF homes is that there is an adverse situation with tenants, for example, evictions, that may require a legal process.
Yeah.
How does Roofstock help alleviate that concern?
So that would be through using professional property management. And within buying real estate, you can buy a property and either manage it yourself or use professional property management. And highly, highly recommend using professional property management. It just allows you to scale and it makes it passive. It's never really passive if you're doing the management like on your own, just because, I mean, that's work in itself. And typically what you would pay a property manager would be anywhere between 6% and 10%, or maybe even 12% of the rent that they collect. They get to keep that fee. And I think it's worth them paying that fee to manage the other overhead.
All right. And JA just mentioned his IM here publicly as well, and it says this is the person who just commented privately. He echoed the same thing publicly. He just closed on property in Ohio, and he has the mortgage in his name, but the county requires that the spouse be on the title of the deed. It might be dependent on the county.
Yeah,
it's his comment.
I like it. Yeah.
All right. And could you recommend where to get a home equity line of credit?
Yeah. So Third Federal has some pretty wild low rates. So a home equity line of credit, just a quick primer on that is, yeah, I should, a home equity line of credit is basically taking the difference between your home loan, your original loan, and the value, 80% of the value of the home. But Third Federal is a great place. I'm going to keep rolling through the presentation right now, and then we'll hammer on more questions to go through. Great. It's segue. So different financing options in buying. There's all cash. This is the fastest way to close. Downsides, it's low on that cash on cash return. So when I showed that example in the beginning, since you're putting all cash in, you're not taking advantage of any of the value of leverage. There is traditional conventional loans, which is that up to 10. I love it. I think it's great to take advantage of that just because the rates are just so cheap. And then you get into private money and hard money. And these can work especially as you're scaling, but it's just typically a little bit more expensive than you would get in that traditional. Renter type strategies. So I'll just touch on these very quickly. So there's a traditional kind of buy and hold, or excuse me, person who's living in the house, right, as just kind of a standard process. And this is oftentimes, specifically with single family, they tend to rent for a long period of time. There's a lot of people looking for this. I think a lot of people were, with COVID and the pandemic, were thinking, like, watching this very quickly, what would happen to occupancy rates. And what has happened so far is people living in apartment complexes, they want to move out of the apartment complexes and move into rentals of single family houses to have their own, a little bit more space. So there actually demand has gone up for single family rentals during the pandemic. There is Section 8, I think, is a totally fine strategy, and this is government subsidized housing. There are some intricacies as it relates to operating and picking a property manager. I would pick one that has some experience in this. And then there's student housing as well as vacation rentals. Vacation rentals, less like keen on this. I think if I'm trying to like maximize investment, I find that in vacation rentals it's not necessarily there just because prices are typically way more expensive in the house. All right, some other decisions. So buying local or out of state. Buying local much more control, more transparency, more overhead. But the biggest thing is available inventory. I live in the suburbs of San Francisco over in the East Bay and Orinda, and there's just not a lot of properties that would pencil anywhere remotely near. So that's why I buy out of state. I use third-party property management and manage through that way. Buying occupied or vacant. Personally, I'm indifferent. I've bought in occupied, I've bought in vacant. I think there's different processes in the way that you evaluate homes, either or. If it's occupied, knowing what their payment history is, knowing what the terms of the lease are is important. A benefit of buying occupied is it's cash flowing right away. Buying vacant, there's benefits in that, and that you can be part of the tenanting process. So in selecting your property manager, kind of asking them about what their criteria and recommendations are. But I think ultimately the asset is going to stay. Like there's going to be cycles when it's occupied, cycles when it's vacant. That's why it's less important if it's occupied or vacant at the time you acquire it, and more that the property is in a good position to meet your financial goals. Self or professional property management. I love professional property management. You're paying a little bit more money, but it's really the key to scaling and doing it remotely. And they're going to help if there are legal issues with the tenant. The professional property management, they would be able to manage that. And some of them even have like insurance products around like evictions. And again, this is something that I've found to be not happen very often, but if that's a concern for you, like they have some potential on that. Types of risks. So one of them would be property condition. The big one, structural. I stay away from properties. I'll look at the inspection report. If there's anything that has to do with foundation, roof, just like major property systems, I'll stay away. That's a good way to mitigate. Tenant is another risk. Ways to mitigate this, if you're, as I mentioned, you're buying occupied, getting what the seller's screening criteria was, getting what the payment history is. And then you can also identify markets that has lower vacancy. So another thing to note, like if you're buying like in the sticks, like somewhere way out where, like they might have higher listed returns on a cap rate just because the prices are very low, but there might be more risk for vacancy just because there's less of a dynamic economy there. And a way to avoid some of those tenant risks would be buying in an area that has a little bit more population. I like to look at like professional sports team is a great, or even a AAA team is a good way to say, okay, there's enough people there that I don't have to worry about that. The last one is market. And I think as a long-term investor, I'm less concerned about swings in the market. Just because I have faith in just the U.S. economy over the next 10, 20 years. I'll send you guys a link to this cheat sheet. It has a couple of questions you can ask property managers and lenders, as well as things to do. And then I'll just close out with some really quick recommendations. Follow this checklist that we'll send you the link to. I'll send it to Daniel. Leveraging your PM. So once you've identified a property manager, get them involved in the acquisition process if you're buying remotely. Say, hey, what do you think of this area? What do you think of this house? You're not saying that you're necessarily using them, but it's a great way for them to kind of prove themselves and to get their feedback. And the last thing is to get your at-bats. So starting to talk to property managers, starting to talk to lenders, starting to evaluate properties. And then lastly, the best way to move faster is getting like a coach or a mentor or someone who can, be a sounding board and kind of hold your feet to the fire on moving forward and provide a sanity check. Excellent. So let's head back to questions, Daniel.
All right. A couple of questions have just popped in the last few moments here. How do you evaluate a good property management team? What's a good percentage for property management costs?
Yeah, so a good property management team, I would look at the number of units they have under management. I prefer, there's two schools of thoughts of this. There's they only have a couple of properties, so I'm going to get these much better kind of hands-on. But I would much rather have like a bigger property management company with proven systems. I'd want to look at those KPIs. So what's their occupancy rate? What is their standard operating procedures as it relates to setting a new market rent? Who's my contact point? Give me some references, and don't give me, the phone number to your cousin or something. Like a couple of outside good references. Pricing, it depends on what market it is, but I've gotten as low as 6%. I would also take a look at their property management agreement. The biggest place that I've gotten caught on with a property manager is when I sold a property, they came back to me and said, "Oh, you owe me some money." Oh, my screen keeps changing. You owe me some money because there was a clause in the property management agreement around selling. And so looking at the property management is an exercise. The agreement is an exercise worth doing.
All right, next question. A lot of properties with occupants have under market rents, which make the cash flow limited. Unless we kick out the tenants and find new ones, what do you recommend in dealing with this situation?
First off, I think that's a fantastic way to find value is finding a property that's rented below rent. There's a humanity side to this, right? Like I think this is an awesome way to build wealth, but I think it's an awesome way to be like a human. So I would say take it case by case. If I'm thinking about owning this property for 10, 20, 30 years, like if somebody's there and in a situation where they're living there and they don't have a better option and it's a little bit under market rate, like I'm okay taking a little bit of a haircut for, whatever that case is. I'm probably am a softer on that kind of stuff, but I think ultimately, the rents will continue to go up. And I'm not saying that you do it as like a charity case, but like be human about it and take it case by case. But I think that's a great way to find value is under rents that are under value.
Let's see. What criteria does Roofstock use to research markets they enter and sell properties in?
So we have a database of like every rental property in the US. And what we've done is we found the ones where we have the best ratios to rent and price, but then also that there's enough volume and transactions. So we're looking at markets that are getting larger, right? So like a big place, markets the down in the Southeast is a major trend. There's this economist, a guy named John Burns, who's sort of the like a major thought leader in the single family space, and he wrote this book called Big Shifts Ahead, where he's super bullish on the Southeast. We'll also just go to where the market's at. So like if we have sellers that have listings under a certain amount, over a certain number of listings, we'll open up a market there. I'd say the biggest thing that Roofstock needs to solve is making sure that we have enough inventory on the site. So, at any given point in time, there's going to be a lot more, properties available. Going to markets with more inventory. So wherever the demand and supply is at, yeah. Kind of a word vomit.
I'm gonna combine these two questions, and they're both about property management. And one is that I've heard that a good property manager will only work if you own many properties. And then the kind of the corollary to this is Eugene says, in terms of vetting property management places, I have heard that a tip on researching how many lawsuits they have outstanding. Tom, what do you think about that?
Property management, there's companies that definitely will just manage one property for you and do a fine job at it. I would make sure that in going to a market, knowing who are the biggest property managers, I wouldn't, like I said, I would want to go to a larger one. I mean, I'd go through the whole process of asking them their standard operating procedures, some of these key KPIs, but they will definitely, manage an individual property. On the lawsuit question, it's worth taking a look on Yelp and seeing what kind of like reviews and looking at what kind of lawsuits they have. But I would take, at least on the Yelp reviews, like with a grain of salt, not a piece of salt, just because oftentimes the relationship between a property manager and a tenant like is kind of a one that is inherently like a little bit rough, and that this person is just collecting money. With that said, like if there's some like obvious themes around neglect as a property manager and like not taking care of the properties, like those would be some red flags. But I think that's not a bad way to go about it, is like looking at what lawsuits are available or on a tenant.
And Francine is wanting to know about the eviction moratorium and how you think that affects returns this year.
Yeah, as an investor in single family rental, I haven't seen a lot of it. Where I think a lot more of that stuff is like apartment complexes. Something in thinking about evictions and people deciding to stop paying rent, if you have a huge apartment community, in the person next to me in my apartment is not paying rent, like I'm going to be way more or less likely to want to pay rent if I know the people next to me are. So I'd say like that kind of process moves a lot faster in apartment complexes versus a single family rental where it's like dispersed assets and there isn't this sort of momentum within the people that live there. So far, like the eviction things, it's, you know, October now, hasn't really touched, has not been that impactful in the single family space.
All right, one last question, and then Tom, let's have you, if you're willing, give your contact information.
Yeah. Yep.
Last question is, other than Google search or Yelp, are there any sites or sources that you would recommend for looking up reviews on property managers?
Yeah, so I mentioned Bigger Pockets is a good one. With that said, I would have a grain of salt. I'd bring that grain of salt back out, in that a lot of those companies are probably writing like on themselves, like there, but like writing on themselves. You know what I'm saying? We have, so the Roofstock has a program, Roofstock Academy, where we have like a private forum. There's roughly like 300 or so folks in it that we're constantly talking about lenders and property managers in other areas. So that's like that's our like paid program that we have. But I think Bigger Pockets is a great spot. Yeah, I would take a look. NARPM is another website, the National Association of Real Property Manager Professionals, I think. There's like a certification of joining that. It might just be a fee, I'm not totally sure, but it's another data point. It's another resource. NARPM.
All right, excellent. And Tom, can you give us contact information and how people can get in touch with you?
Yeah, so being an earlier employee at Roofstock, I'm Tom at Roofstock. So feel free to reach out with any questions. Yeah, love talking about real estate. And thank you so much, Daniel, for bringing me on. This is fun. I love talking about it.
Oh yeah, thank you for coming on and sharing all this information with us.
Yeah.
So if people want to contact you, reach out to him on his email. Otherwise, I'll put the link to the cheat sheet that he's going to send me in our SharePoint notes. We usually take notes on each of our meetings, and it'll be posted there. I'll probably also put it on the video portal directly underneath the video recording. All right.
Awesome. Have a great weekend, everybody.
Thank you.
Thanks, you too.